similarities in deferred tax asset and deferred tax liability. Both are happening due to a temporary difference. It is expected to reverse in the future, right? It's a temporary difference. You might be paying extra taxes now, right? Which means you will have to pay lower taxes later, and when that is realized in the future, it will lead to lower cash outflows, and that's why you're recording an asset now, right? So that's very similar to how a deferred tax liability works. The only difference is in future we have to pay more, that's why we record a liability, but if in future we have to pay less, we will record an asset, right? Now this is important. Sometimes what happens is that it's not a temporary difference, right? It's a permanent difference in what is the accounting profit and what is the taxable income. Why does that happen? So on the revenue side, there could be some revenue that we are recording, right? But the government will never record. Or there could be some expense that we are recording, but the government is not recording now, and they will never record in the future either. So it will lead to a permanent difference. Let me give you some examples. So let's say interest income from municipal bonds. Now, municipal bonds are bonds issued by semi-government organizations, and most of these bonds are actually exempt. The income that you get, the interest income you get from them, is exempt from tax. So you will be showing that income in your revenue, right? You will not be taxed on it. As far as your accounting profit is concerned, it is going to include this income, but as far as your taxable income is concerned, it will not include this income. Not today, not ever, right? So this leads to a permanent difference, and because it leads to a permanent difference, we are not going to record this as a deferred tax asset or liability, right? Similarly, expense. Let's say you pay a fine because you broke the law, you did something wrong, so the company has to pay a fine, and this expense will be recorded in your financial statements, right? As far as US GAAP and IFRS is concerned, they would want you to record this expense and show it to the users of your financial statements that you've had an expense, but it is not going to reduce your taxable income. It is not a tax deductible expense, so it will never, not today, not ever, going to impact your taxable income, and this is also going to lead to a permanent difference, and this difference we will not record as a deferred tax asset or liability, right? Because it's never expected to reverse, right? Now, sometimes what happens is that there could be uncertainty. Now, this is different from the examples that I gave you, that certain revenue the government will never record, or certain expenses the government will never record. But sometimes what happens is that you've recorded a DTA because, let's say, the government asked you to pay more tax today, so you paid extra, and the reason for that is because you had got some unearned revenue, right? So the government said, no, this is your revenue because we've seen that amount in your bank statement. So they took that as their revenue, and they asked you to pay extra tax, and you did pay it, and you recorded a deferred tax asset. And you were expecting to make the delivery the next year, right? You were expecting to make the delivery the next year, and then obviously reverse that deferred tax asset, because then you would recognize that revenue, and then therefore you would have higher profit, but you wouldn't have to pay tax because you've already paid it earlier. So then you would have to pay less tax, which means you could have reversed this DTA. But let's say something happens and you are unable to make delivery, right? In that case, obviously that revenue will never be recognized, and what you should do is that you should not record that DTA if you feel that you will not be able to realize that benefit. Now, let's say you did record it, right? So DTA was previously recognized. Then how could you reverse it? Well, in IFRS, it's very simple. You can just directly reverse it. But in US GAAP, you have to show something called a valuation allowance. So let's say I record a DTA of 5 million, then I will not just delete it and make it look like nothing. I will make it still zero, but I will first say that there is a valuation allowance that I am recording for 5 million, and this is something called a contra asset account. What that means is that it will be recorded on the asset side of the balance sheet, right? It is going to be shown under your asset of DTA, but it is going to have a negative, which means it will be reducing this asset, right? So that's why it's called a contra asset account. Right, so tax base of an asset. Now, this brings me to another contra asset account, that we have our property, plant and equipment of 100 million, right? And we have our accumulated depreciation, which is another contra asset account because it is shown on the asset side of the balance sheet, right? This is shown on the asset side of the balance sheet, but it is reducing my asset of property, plant and equipment, and I am showing a carrying value of 90 million because the accumulated depreciation is 10. However, as far as the tax authority is concerned, they might be saying, okay, on your balance sheet, we know there is an asset of property, plant and equipment of 10 million or 100 million, but we think that your depreciation should be 40, right? So then they will obviously show a tax base which is much different than what we are showing as our carrying value. Now, this is obviously for property, plant and equipment, but there are other balance sheet accounts that can have different values, right? So the depreciation one is easy. We've talked about that earlier. Let's talk about it again. Let's say you purchase an asset for 50, right? On the books, your financial statements, you're depreciating at 25, but on your tax, let's say you're doing 40 and 10. So what will happen is, as far as your balance sheet is concerned, for your financial reporting, you will show the asset for 50, then you will reduce it by 25, then you will reduce it by 25. But for your tax base, you will show the asset for 50, reduce it by 40. That means it becomes 50 minus 40 is equal to 10 in the first year, and then the next year it will be 10 minus 10 is equal to 0. So this is how you can have a difference in the carrying value and the tax base. Now, this formula you can memorize, but what I would suggest is try to understand what's really going on over here. If you take the carrying value, right, after 1 year, obviously the 50 had become 25 as far as your books are concerned, but it had become 10 as far as the government's books are concerned. So the difference between this 25 and 10 is basically the difference in the depreciation amount. So you booked a depreciation of 25, the government booked a depreciation of 40. So what is that difference? It is basically 15, right? The government booked 15 more than you. And you can take the difference of the depreciation like I have done, or you can calculate that amount using your difference in the carrying value that is showing on the balance sheet and the tax base. So that will give you what is the difference in the amount of depreciation booked, which means if the depreciation has been higher, let's say the depreciation has been higher by the government, that means the profit must be lower, right? And if the profit is lower, then the tax would have been lower. Now, based on how much lower the tax would have been is how much we would have recorded a deferred tax liability, because later we will have to pay that. So the question is how much the tax would have been lower. Well, it depends on how much depreciation was higher. So we know it has been 15, which is 40 minus the 25. Or you can even calculate that 15 by taking the difference in your carrying amount and tax base. And the question is, what do you do with that difference? Well, you multiply it with the tax rate, right? Because that is how you can calculate the tax that you paid less. The entire amount is not going to be saved in the tax. The depreciation difference is going to impact the profit, but the profit, when converted to tax, is done at a tax rate. So if let's say that tax rate is 40%, so 40% of 15, which is 6, is going to be the difference. So the tax that we have paid is lower by how much? 6 million. And that is the amount of deferred tax liability that we will record. In the next year, of course, it will be reversed, because in the next year, the depreciation that the government is recording is only 10, whereas we are recording 25. So we are recording 15 more, right? We are recording 15 more, and therefore it is going to be, government will record a lower depreciation, which means the government will have a higher profit, which means the government will ask for a higher tax. And how much higher? Again, it's going to be the same amount, and therefore this DTL will be reversed the next year. Right. So obviously, if the carrying amount is greater than the tax base, that means the government is recording a lower tax base, which means they recorded a higher depreciation, right? Let me repeat that. If the tax base is lower, if the carrying amount is greater, that means the government has depreciated more. And if they have depreciated more, means higher expense, means lower profit, means lower tax. You've paid less today, you will have to pay more in the future, and therefore what you will record is a liability. Right? If you have been depreciating more, which is the carrying amount is less, that means you've been paying, or you've been calculating less profit because you've been having a higher expense, but the government has been calculating a lower expense and a higher profit, and they've been taking more tax from you, but you have paid in advance, and therefore it's a asset for the time being. And as long as it is expected to be reversed, you will record it on your balance sheet. Again, I mean, you can try to memorize this formula, but what I would suggest is try to understand what's going on, right? And let's again take the example where we saw that income tax expense was coming to 10, but we were only paying 6, right? And therefore, or we were only paying 4, and therefore we were recording an increase in deferred tax liability of 6. Now, the only thing that is complicated over here is sometimes a company has a deferred tax asset as well and a deferred tax liability as well, right? So what you have to see is you have to calculate the net DTL. Now again, instead of going into this formula, what I would suggest is that you try to intuitively understand that if this is going up and this is also going up, but DTL is going up by 10 and DTA is going up, let's say, by 15, so which means the net DTL is coming down by 5, right? And let me show you with an example. So let's say the income tax payable for a certain company is 100, right? This is what they have to pay to the government, right? During the year, DTL increased from 20 to 25. Now, if your DTL went up from 20 to 25, means it went up 5, right? 25 minus 20. Your DTA is going from 0 to 10, which means it went up by 10. So what's really happening over here? If your asset is going up by 10, your liability is going up by 5, then the net impact is that your DTA has actually gone up more than the DTL by 5. And if DTA is going up, that means you've paid extra tax today. Of this 100 that you have paid, 5 is extra. So as far as your income tax is concerned, you must have calculated 100 minus 5, which is 95. This is what you must have calculated, but you ended up paying 100, which is that 5 extra that you have paid, and that is why your DTA has gone up more, right? But you could also obviously apply this formula that the income tax paid, which is 100, right, is equal to the income tax expense, which we have to calculate, plus the net DTA, and net DTA is basically your, net DTL, and net DTL is basically your change in DTL, which is plus 5 and DTA is plus 10, but here the minus sign is there, so it will be minus and then plus 10, which basically becomes minus 10, right? So it's going to be 100 plus 5 minus 10, which comes to 95. But then again, I wouldn't use our limited space in the mind to memorize this formula. I would save that space for some other formulas, and this I would try to solve with your logic and intuition. Right, now determining the tax base of an asset, again, the carrying value can be different from the tax base, and that depends on the depreciation amount if it is related to depreciation, but there could be other examples. So let me give you all the different examples one by one. First, the depreciation one, which is simple, right? So if you're having depreciation of 25, government is having depreciation of 40, you bought the asset for 50. So here you will do 50 minus 25, which is 25. Government will be doing 50 minus 40, which is 10. So there is a difference of 15. Now, as you might remember from our discussions on capitalizing research and development, we know research is expensed and development can be capitalized depending on if it is IFRS or US GAAP, and within US GAAP if it is software or not. But anyways, let's not go into the details of that. Let's say you have a capitalization of 100 of certain development cost, and this is being amortized. Maybe it was a patent which has a limited life, right? So as far as your books are concerned, you are amortizing 30. So 100 minus 30, you will show it as a carrying value of 70, whereas tax is only allowing 25% amortization, which means 100, and 25% of 100 is 25. So again, there will be a difference over here in the value of this asset showing on your balance sheet as far as your books are concerned and as far as the government's record of your books is concerned. Right. Now, research cost is always expensed, whether it is IFRS or US GAAP, but as far as the government tax law is concerned, that they will require you to spread this across 5 years. So in your books, you will show nothing for research, right? You will expense the whole thing in the first year. But the government will say no, expense out 1/5 and the remaining do it over the next 4 years. So show this asset for the time being, and therefore there will be a difference in the value of that asset on your books and on the government's records of your books. Coming to accounts receivable, and remember the bad debt discussion that we had, right? So let's say your account receivable is 100 and you feel that 10% is not going to be coming back. So 10% of 100 is 10. So you're showing the net account receivable as 90, whereas the government is being very, very nice over here. They're allowing you 20%, which means 20% of 100 is 20. So they are allowing you to actually record a higher expense, which is rare. But of course, it is leading to a difference in the balance of your account receivable, net account receivable showing on your balance sheet. What could there be in terms of a liability? Of course, unearned revenue, right? You might have received the payment from a certain customer, but you haven't made delivery for that. So you might be showing a liability as unearned revenue, but the government might not be showing that at all because they are probably going to include it in your revenue for this period. And then a very, very interesting situation that if there is some kind of permanent difference, and I told you about this already, such as interest income from municipal bonds or payments of fines that will never be accepted as expenses by the government, right? So they will never be reversed. These differences between your accounting income and taxable income will never be reversed, and therefore they do not give rise to DTLs or DTAs, right? Examples include income or expenses not allowed, such as interest income from municipal bonds or fines that we will record as expenses as far as our financial statements are concerned, but the government will never take those fines. as tax deductible expenses. Sometimes the government is very nice. They give us tax credits, right, for maybe using solar panels, which is good for the environment, or maybe something good for the society, right? So there are some things that if companies do, the government gives them a benefit for that by providing them a tax credit, but those tax credits are not shown on our financial reports, and therefore they do lead to differences in accounting profit and taxable income, but those are permanent differences, and therefore we do not record them as deferred tax asset or liability. Right. Now, what happens is that if these permanent differences are there, then, well, let's say there is some income which is coming from interest income, right? And this is from municipal bonds, which means it will be there in our financial reports, but the government is not going to tax us on it, and therefore our tax rate will be lower, right? Because we're just going to end up paying lower tax, which means the amount of tax expense we will record is going to be low as well. Now, if it was something that was a temporary difference, right, then we would record a higher expense and then reverse and record a deferred tax liability, which means later we have to pay it. But since it is a permanent difference, we're just going to record a lower expense to start with, right? And therefore, if you really want to know the effective tax rate, all you have to do is take the expense that you are recording on your books, take the pre-tax income which you are recording on your books, right? Because your books are going to be accurate because you're not recording that permanent difference as a deferred tax asset or liability. Therefore, you can just take the amount from your books, both the numerator and the denominator, and then you will be able to calculate your effective tax rate. Let me give you another example. Let's say that we are paying a certain fine because we've done something wrong, right? And we have to pay a fine, and we know that this fine is not going to reduce our tax because the government is not going to allow it. So we will just directly record a higher income tax expense than we would have otherwise, right? We will include this fine as part of the income tax expense because multiplied by the tax rate. Basically, we are not going to reduce our income tax expense by this fine amount because it will never be accepted by the government. So we'll just record a higher income tax expense to start with, right? And therefore, if you want to calculate your effective tax rate, all you have to do is just take your income tax expense from the books because it has been recorded higher to start with in the first place. Just to make sure you're getting the point here, so please try to attempt this question. It's a trick question, all right? And it's a very straightforward, simple question, but the trick is not to fall for the complexity, additional unnecessary detail that has been provided. So pause the video and try to solve this. Right, so hopefully you didn't fall into the trap of using the tax payable and the taxable income, because since we're talking about your permanent differences, so you can just take the income tax expense and your earning before tax that has been calculated on your books, and that will give you the effective tax rate. So that is it for this video. In the next one, we're going to, right, hold on just 1 second. So temporary differences obviously give rise to a deferred tax asset or liability, whereas as long as they are expected to reverse, right? But permanent differences, they do not give a rise to deferred tax assets or liabilities. Okay, so we do have some material left for deferred tax asset and liability. So let's cover that. Now, if you have an asset on the balance sheet, right, and the carrying amount is greater than your tax base, which means the tax authorities have been recording a higher level of depreciation. That is why your tax base is lower, which means you've been paying less tax today because higher depreciation means lower profits as far as the taxable profit is concerned. So you're paying lower tax today, but you will have to pay higher tax tomorrow. So you're going to record a liability, right? I mean, I would really recommend that you remember this intuitively. Don't try and memorize these things. Use the memory space of your brain for those things which you really have to memorize. But this is fairly intuitive, so you can actually remember this intuitively. Similarly, if the carrying amount is less, which means you have been recording a higher amount of depreciation than the government, and therefore the amount of tax that you have been showing payable is less than what the government has been asking for. So your tax amount or tax expense has been less than what the government has been showing, and therefore you've been paying extra. But I think better, it's not usually the situation with depreciation that the government is having a lower than amount than you. This is more appropriate for research cost. So let's say you expense the whole thing, right? So your carrying amount is 0, whereas the government only allowed you to expense 1/5 of that, and they want you to spread it out over 5 years. So they will be showing a higher tax base, right? But because your expense is greater today, so as far as your books are concerned, you should have paid a lower tax, but you paid extra, which will be reversed in the future. So this is an asset for you. You've prepaid your tax. Right? Now on the liability side, let's think of unearned revenue here. Now, the unearned revenue that is showing on your books can be greater than that is showing on the government's record of your books, because the government didn't record that unearned revenue because they just took it within revenue, right? So therefore, they will have a higher revenue for you, which means for this period, which means a higher profit that you've paid tax on. So again, you've prepaid tax here, and later when you show that as revenue in the next period, you will have a higher profit in your books, but you won't have to pay tax on it because you've already prepaid it, and that asset of deferred tax asset will reverse, right? And for your liability, where let's say the carrying amount is less than your tax base, then obviously the situation will be different, that you will record a deferred tax liability instead of an asset, because you will have to pay later on.